traded funds and closed-end funds for income. When I go to Morningstar for data, I note that some of the income comes from return of capital. Is that good or bad, or rather, when is it good or bad?
Yeah, so Mike, I'll sort of explain to you the return of capital and closed-end funds, but before I do that, be very careful. I would tell you, I used to work at a mutual fund company called Pioneer when I started in the investment business, and what a lot of mutual fund companies do is, in an effort to raise money and give brokers something to sell, is they come up with this great sending strategy for a closed-end fund that usually is something around generating income for investors, and so they go out and they try to raise $500 million to $1 billion real quick, and it gives a broker something to sell. So they have Salesforce that goes to talk to the Merrill Lynches of the world, and then the Merrill Lynches talk to their clients and say, look, this company like Nuveen or Pioneer or MFS has this new closed-end fund, and their target for income is going to be 7 or 8%, and they do that with a lot of leverage is how they get the income. But what usually happens is they sell it to a bunch of their clients, and then immediately goes trades on the secondary market, and the price of the closed-end fund drops pretty significantly. So there are closed-end funds out there that have already dropped in price significantly, where there is some value. Troy and I just don't happen to be big proponents of those, because a lot of times in an effort to juice income, maybe the underlying income of a portfolio might only be 4%, but in an effort to get it to 6%, they add 40% leverage or borrow money to it to juice the income, and that can be dangerous, especially in a down market. If you look at a lot of these closed-end funds that focus on income, and you go back to 2008, 2009, some of them lost 80% or more in value, and that's what you have to be very careful of. So to answer your question directly, Mike, what closed-end funds try to do is they try to provide you the income in the most tax-efficient manner, and so a closed-end fund has to distribute income. So if they have dividends, they have to distribute that, and if they've realized capital gains, they have to distribute that. But they also have the choice to return some of the original capital, and they do that sometimes. So let's say that 50 or 80% of the money that they're going to distribute is the income and then the realized capital appreciation, but they're going to distribute another 20% in the form of return of principal, because that return of principal doesn't have any tax liability to it. So a lot of times what they're trying to do is give you your distributions in a more tax-efficient way than if they just distributed income and capital gains, realized capital gains, because that's all going to be taxable. Return of principal is going to be not taxable, and so let's say you get, just to make it easy, let's say you get a 10% return, or 10% income, and 80% of it is taxable because it's capital gains and or income, and then 20% of it is a return of the original investment. That 20% isn't going to be taxable, so that's going to be a much more tax-efficient way. And so fund companies that have closed-end funds, Nuveen is probably the biggest one with closed-end funds. They try to do it in the most tax-efficient manner that they can, and still, because future shareholders, at some point you're going to return all the capital, but there's no pluses or minuses to it, and they're going to do it differently every year. You do have to be careful about some of these ones that in order to keep the income up, they just return principal, and that's the only way they can do it, because that's essentially a legalized Ponzi scheme that only works for a little while. We're just not big fans of closed-end funds, and I know everybody out there is looking, Mike, for income, and that's a primary source, but in a low interest rate environment, instead of focusing on income, focus on total return of a portfolio, and then sell assets down to create your income. Don't focus on income. If you focus on income, you're going to get burned when rates go higher and or we go into a recession, because people that are focused on income right now, they're looking at the most attractive yields, and in order for something to be yielding a lot, it either has to be really long in duration or really low in credit quality. And if we have a recession, that's the stuff that gets wiped out. And so your focus on income is misguided. I would tell you that's just our opinion. We think you should own higher quality assets and think about total return rather than income, and you'll be better off. At some point in the future, people will be able to focus on income again, and